market has been rough these last few weeks. And it's not like a little rough that's kind of playful that everyone sorta enjoys. This is sandpaper rough. I am chafing. But there are a few bright spots in this mess. For example, one blue chip stock is actually up over 3% in the last month while the rest of the market has been down. Can you guess which one it is? Here, I'll give you a little hint. I like cheese. Did you figure it out? Or do you just feel uncomfortable after watching that? It's okay, I feel very uncomfortable after doing it. But yes, you're right. Today we're gonna be talking all about the fat pitch that is Disney. And it's all going down on this week's episode of Real Vision's The One Thing. What's going on, investors? AK here. Now, in a recent note that appeared in Real Vision's think tank, the extremely smart and ridiculously good-looking Alex Barrow from MacroOps explained why the market is completely misvaluing Disney. See, with problems like ESPN subscribership falling off a cliff and Disney's slow move into streaming, investors have been souring on the company's stock price. They just don't trust Disney to successfully transition into the cord-cutting era. And that is honestly crazy when you think about all of Disney's invaluable content, their huge brand moat, and most of all, their all-star CEO Bob Iger. Now let me tell you, Bobby Iger is hands down one of the best in the game. And look at him. Not only is he amazing at running companies, but with that smile, I have no doubts that at the ripe age of 67, you could still cast him as the lead in a Disney Channel original movie and it would be a smash hit. He would kill it. I'm telling you, Bobby Iger, he is a straight up star. But right now, even though Disney is coming out with their own Disney flicks, they aren't even being valued like a streaming company. Netflix trades at a price to sales multiple of over 11 times. Disney only trades at 3 times. This is a huge mispricing that shows how much runway Disney stock price really has. Like I said, the market doesn't think that Disney will win the streaming wars, but they already have a great start. Because of their Fox acquisition, they gained control of Hulu, which already has 20 million US subscribers. Now Netflix only has 57 million subscribers in the US, so it's not a bad start. And I mean, yeah, Disney doesn't have masses of people trying to Netflix and chill, but they do have a good amount of people trying to Hulu and hang. And again, let's not forget about all the extremely popular titles that Disney owns and has exclusive streaming rights to. So I'm talking Disney princesses, Marvel, Pixar, ABC, ESPN, Avatar, Star Wars. And now that they acquired Fox, they even get titles like The Simpsons and the X-Men. And yes, this hopefully means that our prayers have been answered and we will finally stop getting those trash X-Men movies. And yeah, with Hugh Jackman gone, you're not gonna be able to use him to carry every single movie anymore. You're actually gonna have to have a good plot line with likable characters, which Fox sure as hell couldn't do, so I'm so glad it's in Disney's hands now. But anyway, even with all these titles and such a strong brand, Disney is still selling for much cheaper than its competitors. Disney trades at just 11 times enterprise value over EBITDA, and that is much, much lower than Fox, Lionsgate, and even Discovery Communications. Yeah, Disney with Spider-Man, Luke Skywalker, and Frozen, they're cheaper than the freaking Discovery Channel that has shows like Naked and Afraid. And I mean, sure, I've been naked and afraid a bunch of times, especially in college, but you don't see me making a show out of it. And some of you might be saying, but wait, AK, what about that great Discovery show, Finding Bigfoot? Finding Bigfoot? Really? We've already found Bigfoot. His name is Shaq and he's a national treasure. Case closed. Now I understand that it may be tough for investors to see old school Disney as this new Alex Barrow level sexy streaming company, but the reality is exactly that. And the streaming subscription market is blowing up. More than 60% of US households are subscribed to at least one streaming service. And analysts predict that global subscriptions will grow by 409 million going into 2023. There's a lot of money to be made here. Just check out what Katie Stockton, the founder of Fairlead Strategies, has to say about not only Disney, but the entire communication sector.
The market's been incredibly interesting from a technical standpoint. We have one of our biggest oversold buy signals, so to speak, of the year. And it's something we only usually see maybe 2 or 3 times a year in terms of the way the market internal is set up. And by that I mean breadth and leadership and sentiment. We had such oversold extremes registered last week when the S&P 500 dipped below its 200-day moving average, that to me, it's a buying opportunity.
So if you haven't already, it's time to take a look at Disney again. It is a fantastic long-term play. And if you want to dive deeper into Disney, then check out Real Vision's think tank, where you'll find independent financial research from guys like Alex at MacroOps, along with many other world-renowned analysts.
Well, that's it, guys. I'll see you next week. Haha!